Here is a question that keeps many people awake at night. If the stock market dropped 20% tomorrow, would your life actually change? For most people, the answer is a terrifying yes. Their retirement dreams are tied to a number on a screen that flashes green or red depending on the mood of the market. But for a small group of seasoned investors, a 20% drop is just another Tuesday. They do not panic because their lifestyle does not depend on the market price of their stocks. It depends on the steady, reliable cash flow those stocks produce every single month. Today, we are going behind the curtain to dissect the mechanics of a true $8,000 per month income machine. We are going to move past the surface-level hype and look at the actual data and historical evidence. We will analyze why certain exchange-traded funds are built like fortresses to protect you during a crisis. And I will show you exactly how to structure your assets so you never have to sell a single share to pay your bills. Whether you are already retired or just a few years away, understanding these mechanics is the key to true independence. Let us begin by validating a very real concern that many financial advisors ignore. The traditional retirement model is broken for the modern world. For decades, we were told to follow the 4% rule. The idea was to build a large nest egg and sell off 4% of it every year to live on. But that strategy has a massive flaw called sequence of returns risk. If the market crashes in the first few years of your retirement and you are forced to sell shares at a loss, your portfolio may never recover. You would be eating your own seed corn instead of waiting for the harvest. This is why income investing has become the gold standard for those who value peace of mind. Think back to the year 2008 or the chaos of 2020. While the headlines were screaming about a total collapse, many blue-chip companies were still sending checks to their shareholders. According to historical data, even during the worst of 2020, dividend payments from major United States companies remained remarkably resilient. They actually hit new record highs just 3 years later. When you focus on income instead of price, you change the game in your favor. You stop being a gambler and start being a business owner who collects a share of the profits. Now let us look at the first layer of our deep dive, the defensive shield. Every serious income portfolio needs a foundation of low volatility and high quality. One of the most respected tools for this is the S&P 500 High Dividend Low Volatility ETF. Known by its ticker SPHD, this fund does something very specific that is perfect for retirees. It identifies the 50 highest-yielding companies in the S&P 500 that also have the lowest price fluctuations. By focusing on these two factors, SPHD creates a smoother ride when the rest of the market is volatile. Historically, this fund has maintained a dividend yield between 4 and 5%. But more importantly, it holds companies in sectors like utilities and consumer staples. These are businesses that people pay regardless of the economy. They pay for electricity, they buy groceries, and they pay for health care. Another legendary pillar for this strategy is the U.S. Dividend Equity ETF, or SCHD in the world of income investing. SCHD is often considered the gold standard for dividend growth. It does not just look for high yield. It looks for financial strength and a history of raising dividends for at least 10 years straight. Over the last decade, SCHD has increased its dividend payments by an average of 11 to 12% every year. That is the power of a growing income stream that protects you against inflation. When your income grows by 10% a year but your expenses only grow by 3%, you are winning the war against rising prices. Now, let us move to the second layer, the income engines. For many investors, a 4% yield is not enough to hit that $8,000 per month target without millions of dollars. To bridge that gap, we look at modern strategies like the J.P. Morgan Equity Premium Income ETF, or JEPI. This is where we dive into the mechanics of covered calls. Imagine you own a beautiful home and you decide to rent it out to a tenant. The tenant pays you rent every month for the right to use that space. A covered call strategy works in a very similar way with stocks. JEPI owns a collection of high-quality stocks and then sells the right for others to buy those stocks at a higher price. In exchange for giving up some of the potential upside, the fund receives a premium or an immediate cash payment. That cash is then passed directly to you as a monthly dividend. Because of this mechanism, JEPI can generate yields of 7 to 9% even when the market is flat. In fact, during periods of high market volatility, the premiums actually increase. This means that when the market is shaking, your income engine often works even harder. It is a psychological relief to know that the very volatility that scares other investors is actually putting more money in your pocket. We also have to talk about tech exposure through funds like JEPQ. Many retirees make the mistake of avoiding technology because they think it is too risky. But JEPQ uses the same covered call strategy on the 100. This allows you to benefit from the innovation of companies like Apple while still collecting a massive 10% yield. It is the best of both worlds, growth potential and immediate cash flow. Now that we understand the tools, let us look at the math of the $8,000 target. To reach this goal, you do not need a miracle. You need a plan and a timeline. Let us look at a practical roadmap for an investor starting with $500,000. At a 5% average yield, that portfolio produces $25,000 a year. That is roughly $2,000 per month. But if you are still working and you do not need that money yet, you can activate the most powerful force in the universe, the snowball effect. By using a dividend reinvestment plan, or DRIP, every dollar of dividend income is used to buy more shares. Those new shares then produce their own dividends the following month. Over a period of 7 to 10 years, this compounding effect can double your income without you adding another cent of your own money. Historical market returns show that a well-dividend portfolio can double in value roughly every 7 years. If you are starting with a larger amount, such as Jimmy in our previous examples, the timeline shrinks. With $220,000 and an aggressive yield of nearly 9%, the journey to $8,000 a month can happen in just 10 years. This is the deep truth that the financial industry often hides. Building wealth is not about finding the next hot stock or timing the market perfectly. It is about owning productive assets that pay you to hold them. It is about the discipline to stay invested when the headlines are negative. And it is having the wisdom to prioritize cash flow over paper gains. As we conclude this deep dive, I want you to take a moment to imagine your life 5 or 10 years from now. Imagine waking up on the first of the month and seeing your bank account already funded. Your housing, your travel, and your healthcare are all covered by companies that you own. You are no longer a victim of the economic cycle. You are the manager of your own private pension fund. This level of security is not reserved for the ultra-wealthy. It is available to anyone with a clear strategy and a long-term perspective. The best time to start was 20 years ago. The second best time is today. Begin by evaluating your current holdings. Are they paying you for your time, or are they just sitting there hoping for a price increase? Switch your focus to income, and you will find a level of peace that no stock chart can ever give you. Thank you for spending this time with me today. If you found value in this deep analysis, please consider supporting the channel so we can continue to bring you data-driven insights. Remember, your financial future is in your hands. Stay patient, stay disciplined, and stay focused on the cash flow.